What's going on, everyone? Travis the Stock Geek here, coming at you from my new YouTube filming studio. I'm really excited about this. This was one of the projects I was working on over the past 4 or 5 months when you didn't hear from me. And now I'm really excited because I'll be able to bring you lots of great high quality videos about topics in investing that are educational, as well as deep dives into specific stocks and showing you my research process and the outcome of my research. So I'm excited to bring you all of that. And I'm also going to be experimenting with some new content. And today's video is actually the first in a potential series I'm calling Stocks to Watch This Week. And it's basically, a market update about what's happening in the markets this week, key themes that I'm focused on, and also some specific stock ideas or specific stocks I'm watching that could be interesting from a trading or investing perspective. So I hope you find it valuable. Let me know how I can improve it or things that you want to see from me in the comments. And I look forward to creating lots of great content for you in the weeks and months and years ahead. Cheers, everyone. So this is the start of my new series, Stocks to Watch This Week, and it's a great time to actually be beginning this series because we're moving into October in the stock market. October in the stock market historically is one of the most volatile months, if not the most volatile month on average for U.S. stock markets. So what can we expect this October? Well, we certainly have seen a little bit of a correction in the indices over the last week or so. In fact, since the beginning of September, we've seen the indices like the S&P 500 down about 5%. And we've seen European indices down even more as there's fears over the spread of the coronavirus. We've seen a big uptick in cases in places like Spain and places like France. So that is on investors' minds, as well as the fact that there's still uncertainty over fiscal stimulus in the U.S. The U.S. unemployment rate still up at close to 9%. A lot of people still struggling. And the thinking is that we need a second stimulus package to really help with people who are still unemployed or people who have had cuts in income due to the coronavirus crisis. So Democrats have come back to the table with a $2.2 trillion proposal on coronavirus aid. The Republicans want to see a much smaller bill passed. So we're at an impasse, you could say. And given what else is happening politically with elections coming up, it's really uncertain whether or not an actual stimulus package can be worked out between the two political parties. Now, I will say the markets have an interesting way of actually forcing things, and so we could see the markets, if they take a big enough dive, we could see the Republicans and the Democrats come back to the table and actually get a stimulus package done. So that's something to keep an eye on there. But overall, October, again, could be a pretty volatile month, like I said. Looking at the elections, we've got the first U.S. presidential debate actually tonight, and markets are a little bit wary about that. We, of course, have an uptick in the VIX index. It's still sitting at pretty high levels historically here in the mid-20s, so the market's still pretty nervous. Now, looking at the actual elections themselves, it's interesting because although the race looks very, very close, one of the things that isn't being talked about enough is the Senate and the House races, and it actually looks like betting markets right now are showing that they predict Democrats to actually take control of the Senate here in the U.S. Now, that would give Democrats control probably of both the House and the Senate, assuming Democrats retain control of the House, which they have now. If the Democrats were also to take the presidential race, that would mean Democrats would control both the House and the Senate as well as the presidency, and they would be enabled to get through any kind of legislation that they want to get done. So we could be looking at tax increases for corporations and wealthier individuals. We could be looking at some type of green spending package, perhaps infrastructure spending. Could also be looking at things like bankruptcy and banking reform. So these are pretty big deals, which could make a big difference in certain sectors of the economy. Healthcare, obviously another one where Democrats could take back control of healthcare and put in new policies there. So there's a lot that could happen as a result of these elections. Now, one thing that could also happen is we could get a split. Republicans could retain control of the Senate, or they could retain control of the presidency while the Democrats take over Senate and the House. And in that case, the picture looks a little muddier. And so it's not quite clear what happens in that scenario, but markets will be digesting this over the next month or so. Now, we've already seen markets start to punish certain sectors because of the worry about coronavirus and stimulus. So if you look at the retail retail sector, for instance, that's been hit pretty hard over the last month. A lot of retailers down. If you look at the financials, that's been hit pretty hard. Now, energy is probably the hardest hit, and we have seen crude prices come back in a little bit. And stocks like ExxonMobil are actually getting pretty close to their crisis lows from earlier in the year, and that's hitting new fresh lows since the spring time frame. So, keeping an eye here on energy because it is a sector that was already beaten up and certainly more pain here with a lot of these stocks. Now, we could also see that some of these things are getting pretty cheap. And interestingly enough, there's been some recent M&A deals. Earlier this week, Devon Energy announced the acquisition offer for WPX Energy. Devon is a U.S.-based producer. They mostly traffic in the shale plays, and they have pretty good capital allocation overall. It's a company I've really admired, actually, with their management team and the decisions that they've made relative to other energy companies. And so that, I think, is a good deal, too, because Devon is bidding for WPX using stock at a very small premium to WPX's trading price prior to the deal. So I think that could be an interesting deal to watch because it could signal more M&A consolidation in the industry, which may be needed to really limit the amount of supply growth going forward and to help energy prices move back up. So keep an eye on the energy sector. There's definitely some stocks I think that could be interesting there. I will say a lot of people have been asking about ExxonMobil and the high dividend yield, which is now about 10% annually. And I'm a little bit concerned about the sustainability of ExxonMobil's dividend in the near term. Now, the management team has said that they are committed to paying the dividend, but when we look at the financials of Exxon, it's a murky picture because it looks like they may not be able to cover the dividend from operating cash flows over the next year or two. So keep that in mind. If you're buying into Exxon for the dividend yield, that dividend could get cut. So that's just something to keep in mind. Now, if we look at the earnings estimates and what the stock is priced based on those, we're certainly looking like it's trading at discount types of levels. If you look at the earnings estimates for Exxon, for instance, going out a year or two, it looks like they could be expected to earn back up to, say, $2 or $3 a share, which would put, if they're earning $3 a share, would put this thing at just over 10 times earnings. And if you look at a historical graph for Exxon in terms of its price to earnings multiple, the valuation multiple, using the forward price to earnings multiple, ignore this outlier here, it has historically traded in the, let's just change this time frame, historically traded in the mid to high teens earnings multiple range. Now, it's been higher and lower at various times, like in the 2008 crisis, it got down to single digit levels. But today here, like I said, we're approaching single digit levels if this thing keeps falling. So that's something to keep an eye on, as I would consider Exxon a bargain below 10 times forward earnings, especially in an environment where earnings could be a little bit depressed relative to normal levels for Exxon. So what else am I watching? Well, there's not a whole lot on the earnings front this week. You've got a few reports from companies like Thor, which already reported pretty good results there in the RV sector, seeing really high unprecedented demand. And I don't know if that continues a year, 2 years out, but obviously people choosing to travel domestically helps Thor right now. I don't know how that looks long term, but they're definitely benefiting from a shift from international travel to domestic. But with Micron today, we did see that the earnings results looked pretty good for the current quarter, although the guidance for next quarter looked a little light. So Micron was trading down a little bit in after hours, although kind of bouncing around. So that's an interesting one to keep an eye on. That's a stock that's been pretty cheap in the past, but for me is kind of at a level where I'm waiting to see if it's going to make a move down, maybe get a correction later in the year where I could buy this thing like back in the 30s where I think it would be a good value. So keeping an eye there, but like I said, not a whole lot happening on earnings. You do have on Thursday a couple companies like PepsiCo, Constellation Brands, which does own a stake in Canopy Growth, the cannabis producer, and then Bed Bath & Beyond, a retailer. Will be interesting to hear from them and what they're seeing in retail. Other places to keep an eye on, EV sector. It's been really hot. There was an announcement that California is going to ban new gasoline or new ICE car sales by 2035. Now, granted, that's quite a ways out. We're about 14 years from that. But nonetheless, that does indicate that California wants to get really aggressive about phasing in electric vehicles. And so that has really helped a sector that's already been benefiting. If you look at some of the stocks in the sector, they have obviously done very well over the past year. Stocks like NIO and Tesla and Workhorse, but also some of the new SPACs that are taking electric vehicle startups public, like SHLL and KCAC. We got a new one, SBE, which is an interesting one to take a look at. SBE is a SPAC called Switchback Energy, and they have announced that they will be acquiring the ChargePoint EV charging network. So ChargePoint is currently the largest EV charging network in the US currently. And obviously, this is going to be a direct play on the growth of EVs in the US because there needs to be infrastructure built out for charging EVs, similar to how we have gas stations to provide gas to cars all over the country. You could imagine needing a ton of EV charging stations eventually. And right now, ChargePoint is the number one leader as far as number of charging locations. Obviously, there's other competitors. Tesla has their own superchargers. We've got other companies like Blink as well providing EV charging stations. But ChargePoint, one of the leaders, and Switchback is acquiring them. They were acquiring them for a valuation of around $2.5 billion. And this doesn't have a ton of revenue yet, so it's a pretty high valuation. But nonetheless, the company has a huge total addressable market, or TAM as we call it, because these things could be installed all over the country, and in fact, probably all over North America. So they could be an interesting one to keep an eye on, and like I said, are pretty much a pure play on increasing penetration of EVs, which I imagine will continue to happen over the next decade or two. So SBE, definitely one to keep an eye on in that sector, and I'll be watching that, potentially some more upside there long term, especially if more and more investors start to hear about it and get excited about it. And the stock was moving up already on the news of the acquisition, so it's up about 50% from the initial deal or pre-deal price, and trading today around $15 a share, which is, I believe, about a $4 billion valuation currently on the company. But again, potentially on a longer term time frame, could be a much, much larger market for them. In terms of other stocks I'm watching, I've talked about Upwork in the past, but this one's interesting because it's starting to kind of break out. If you look at year-to-date charts, Upwork really starting to show strength and start to test its year high. So that's one I'm keeping an eye on. Both Fiverr and Upwork should be benefiting from this transition to more work remote and work from home, and companies hiring flex workers as opposed to having to pay full-time salary and benefits for every single piece of work they need done. So these companies continue to grow, and Upwork is kind of the leader on the side of the enterprise side of the business, where they look for big corporate clients who can use them to find freelance workers. So Upwork doing pretty well, and that stock technically looking pretty good. So keeping an eye on that. One stock that's in a beaten up sector that's worth mentioning, Nordstrom's. Now, as you know, if you've been watching my channel, I've studied the retail industry very, very closely over the past few months and few years because of my position in Macerich, the shopping center REIT. But Nordstrom's is another interesting one because, like Mac, Nordstrom has high quality shopping centers. They're high quality shops. They basically have locations in just the Class A malls for their core Nordstrom stores. And then they also have the Nordstrom Rack business, which is like their off-price channel. And that's doing really, really well. But the core business has been struggling because a lot of the stores have been closed for part of the year. Now those stores are mostly open, and the management team was at a Goldman Sachs conference last week with pretty positive comments about the pace of business and how it's going. And they believe the recovery of that business, which should happen over the next few months. And despite that, the stock is actually hitting multi-month and multi-year lows. And so we've seen a 25% decline in the stock in just the past month and about a 70% decline in the stock year to date. So this one is obviously been feeling the pain. They do have some debt on the balance sheet, but by my calculations, they should be producing close to about a $700 million in operating profit next year as things normalize. And interest expense on the debt is only about $150 to $175 million on a pro forma basis. So they have the capital and the profit generation to be able to cover that. I'm not too worried about the debt. I know that some people were concerned about that. But overall, I think they can produce about 400 to 500 million of free cash flow. And today the market cap is only about 1.8, 1.9 billion. So you're paying about 4 times free cash flow for this business, which should be the last survivor of all the department stores and should benefit from the closing of a lot of other department stores. And again, they are really just a great retailer as far as innovation. They've got local stores they've been rolling out in LA and New York. They've got a big online presence with about a third of their sales coming from online, and potential to spin out like the Nordstrom Rack business and do a lot of interesting things. And again, they're just one of the more innovative retailers still left around. So I think this one will recover and is a pretty interesting recovery play. Could be some more pain in the near term if we do get a bigger market correction. But overall, this is one I am looking to take a position in, either via options or via the stock itself. So also worth noting that I believe there was some insider buying lately, and then I believe that the management team actually got new stock options issued just recently in the past month. So they've had their stock options restruck, and their incentives are now reset at these lower levels, so they should be incentivized to drive the stock price higher over the next couple of years. So definitely worth noting that as well. Other than that, it should be another big week for IPO pricings. We do have Palantir and Asana doing direct listings this week. And then there should also be an IPO pricing from Academy Sports, which is a regional, I guess you could think of it like a Dick's Sporting Goods, but more of a regional player in the South in states like Texas. So the IPO calendar and the SPAC calendar remains hot. And that's, I think, pretty good sign overall for companies wanting to go public and get liquidity, and also great for us public market investors to have more options to invest in public markets. Outside of that, it is a heavy week as well on the macro data front. The big one, of course, is going to be on Friday. We'll get the non-farm payrolls, which is a jobs report for the U.S. for the month of September. We get that on Friday because September ends, I guess, on Wednesday or Thursday. So we will have the non-farm payrolls report, which could be a market-moving report, especially if it's a weak report. That will spook the market. And again, it could be one of the situations where we see the market react negative, start to sell off in October, and that may force the Democrats and Republicans back to the negotiating table for fiscal stimulus. So ultimately, that would be a good thing. But again, you could see some negative reactions if that is an ugly jobs number and the unemployment rate remains persistently high. So we'll have to see how that plays out. But again, that can be a big market-moving report, and that comes out on Friday. And then, of course, like I mentioned, the presidential debate tonight, there could be implications that come out of that. We do get some manufacturing data from Japan and China this week as well. So those could be market movers in Asia. Outside of that, that's pretty much it from my notes. And like I said, there's some interesting stocks that we'll be watching in the beat-up sectors and also in some of the hotter sectors like EVs and SPACs. So hopefully that's helpful and gives you some ideas and some places to do some more research. As always, if you have any thoughts, ideas, comments, hit me in the comments to this video. Thanks, everyone. Take care.